Hey everybody, this is David Skarika. This is our members update of Profit from Pessimism. So yeah, I hope everybody's good. Uh, so today we're going to talk about an indicator invented by Martin Zweig called the double barrel indicator. And this is we're going to like talk about variations. So the Zweig indicator in the purest form was that basically you would get two double 9-to-1 updates on volume. So basically 90% of the volume would go to advancing issue. So let's say a billion shares traded, just to make it easy, 900 million of volume dollars of volume would go into up stocks and only and like say 50 or 70 billion or seven into down stocks or 70 million in down stocks and 30 million like maybe stocks that are unchanged, right? So something like that. As long as in the unchanged would get thrown out and you go 9-to-1. So this is a very rare thing. So this is like it, these are some of the indicators. This is actually a variation of it. There's a lot of variations of it, but this article here talks about the pure one of it. 67 in a 67-year sample, there's 65 signals for a 1 month holding period. And basically, long story short, for that 2 months holding periods or 60 trading days, that becomes a little more than 2 months because there's about 20 to 25 trading days in a month. So really 3 months. And it says that the average return was about 6%, 6 to 7% over those the 30 or sorry, the 60 trading days that followed, where the average historically is about 1%. So you can see the returns are 6 months. So this is a variation that I found on X on Twitter about it. And this is after the S&P closes at a 6 month low and then has the two of these consecutive 90% up days. So this is not just the pure, this is like 2 days in a row. This has to be like Zweig's thing is that those two up days to down days, I think had to happen within like a 2 month or 3 month period. And there could be no 90% down days in between them, right? So it was basically like it's like a blast off, right? It's like a rocket blasting off. You have these strong volume days that lead it, and you can see all the way through this bull market how much this happened. From 2009, this happened numerous times. You can see really it didn't happen a lot in the 40s and 50s, 70s, and 80s, and then maybe because the markets were juiced by the Fed, but we can see but what we also can see is a week later, stocks are 50-50. And we had a big sell off yesterday. So after the 2 days, which were Friday and Monday, 2 weeks later, you're positive 60% of the time. But the biggest thing is 2 months later and 3 months later. And that's kind of my time frame right now. I'm looking at I'm looking at 2 to 6 months. I think that's when the markets can do well after this, before maybe rolling over later in the year. But you can see, especially the 2 to 3 month period, you're talking 100% and 94%, and this goes back to 1938. And even the couple times when the market was lower a year later, which is only twice, by the way, in this whole sample of this form of the indicator. Remember, this is not the pure 290% days within like 2 or 3 months. This is just that back to back 9-to-1 days after closing at a 6 month low. And you can see it didn't happen very often before 2011. It's happened a lot in recent years. And maybe that's because the volatility of markets, maybe it's because of all this algorithmic trading, computer trading. I don't know why, but we can see it happens a lot more now. And you can see 12 months later, again, we're 100%, or 2 months later, it's 100%. So it's never been down. And you can see some in cases like 13%, 5%, 10, 15% back in 87, 97. You can see the returns were quite large, you know. And the problem going further out is things you don't know what's going to happen further out. For example, in 1997, see how this 14% return after 3 months became 10%. That was because there was a big whack in the markets in October of 1997. And of course, 1987, notice this 20%, 6%, or 19% 3 months later became 1.5% because you had the 87 crash. So you always have to play these things with a grain of salt. But the thing about the double barrel indicator, which I find so interesting, is like Zweig had two main philosophies on the market, which were everyone thought he was a don't fight the Fed. When the Fed's loosening, and which they have loosened, and they're not going to tighten anytime soon. If they're still going to estimate it to be a couple more loosening, 2, 3 more rate hikes or rate cuts this year, and don't fight the tape. So when you're seeing this kind of volume increase, that just tells you that the tape is getting strong. So, or at least a short term trade. And again, I think that here's two scenarios I'm throwing around. because I do think we're near some kind of top in the markets because, the market cap, the GDP, how overvalued stocks are, all this uncertainty over trade, government spending being potentially decreased under Doge, which is short term, bearish for the economy, negative for the economy, uh, that sort of thing. So, anyhow, here's a book. I highly recommend it. It was one of the book that, really influenced me a lot. And he talks about these indicators. Some of them are a little outdated. Like the "don't fight the Fed" thing is really tough now because, of course, in '07 and '01, '02, the Fed was cutting, but these bubbles were bursting. So I think you always have to take things with a grain of salt. But again, in '01, '02, and '07, '08, you can see the tape was not doing well. So that's one thing you really had to take into account. So, but I think these double barrel days that happened are very, very interesting. And my two scenarios, and I've talked about them in the past. I'm not going to get into this too much right now because we're really here to talk about these double barrel um, indicator as of now. And my thing that I'm throwing around right now is uh, like either we could be topping like 2000 or 2007, and in each case, those markets in August of 2000 and in October 2007, after initial 10 to 15% decline, went back to new highs. In the case of 2007, it took 2 months. In the case of 2007, it took 3 months. So that's that 2 to 3 month window there. Or maybe like 1929 or 1987. Again, I'm not predicting a crash, but if we do get some kind of larger event this fall, maybe what happens is actually, because now the pro-growth parts of the Trump administration are going to come in. We kind of had the volatility over Doge cuts and over tariffs kind of out of the way. And now we're looking at Congress, in Congress, we all know moves at a snail's pace. Congress coming in and maybe finally enacting tax cuts, enacting deregulation. And of course, the market is going to rally into any potential tax cuts or into deregulation. And usually when it happens, you kind of sell the news. So maybe we see what happened in 2987. And what happened then was in the spring, kind of like this time of year, March, April, we saw about a 10% correction in markets like we've just had. And then we saw a blow off to new highs. And so maybe this is setting up for a blow off to new highs. And under that scenario, this rally would probably last more like 4 to 5 months into July or August. So, but I definitely think because of what's happened with the huge amount of negative sentiment, the breath now turning around on this rally, probably more positive things coming from the Trump administration in terms of more pro-growth part of their policies. I think now we can kind of maybe set ourselves up. And I had a stock recently that I bought a few weeks ago. I'm up almost 60% on it in a few weeks. So another one I'm up like 11, 12% up in about a week. So, some of these are a couple of my turnaround plays. So, and that's what I'm looking for here. I'm looking for kind of my beat up companies that would have more leverage than just say buying one of the Magnificent Seven or something like this at this point. So anyhow, this is just an interesting indicator. It's something I've known about because I read this Zweig book back in the 90s when I was like 20 years old. And of course, his claim to fame was actually because of the tape and the Fed. He got short and hedged his portfolio ahead of the 1987 crash. That's kind of how he became famous. So everybody take care, and we'll talk to you later. Bye.